barrier is the question of the past. I think it's the lack of awareness that such relations are needed. Investment relations departments are there in the companies, but the frequency of the contacts, the quality of the information provided leaves still much to be desired. So thinking about the future, about dual listings, for example, we will keep emphasizing that. We do hope that we will not get proposals that result from the fact only that we are providers of cheap capital, but I hope that we will get proposals regarding companies that want to get a serious, fair valuation at the capital markets. So maybe it's just that the time is not right for IPOs, or other companies about which we know that they are planning to go public and that they will be going even now. And if not IPOs, then what should we invest in? Jerzy, what do you invest in, and what IPOs would you like to buy? Well, in principle, everybody likes, and all market participants do well in doing it, if institutional investors buy companies that have been first verified by brokers, so that we don't have situations like with the Ukrainian companies last year, because it undermines the trust in the whole region hugely, and it can cause problems even for good companies in the future. And secondly, with a stable market environment, those companies have to be purchased relatively cheaply. They have to offer growth opportunities and prospects. Strategic investors shouldn't just come here to cash in to get by another yacht or another island. There has to be a company that offers potential, which will be, and the IPO should be followed by prospects of growth, so that the investors could make money in the future. What should be the PE ratio so that you can get interested and start reading the reports? Sometimes we can have a biotechnological company where the growth potential is unlimited. Well, if we're talking about a grocery company from Ukraine, well, here, in this case, I would look at the corporate governance, first of all, after all these experiences from the past. And the PE, because sectoral funds or resource or material funds are interested in that. A lot depends on the price of the given raw material, and that translates in the prices and the volatility. So everything depends on the macro, right? If I may interrupt, PE is one thing, price earnings is one thing. Another thing is the quality of this E element, of the earnings. Are they really there, or are they there in paper only, as it turned out in the past in a few cases? It might turn out that the real PE is small, one digit, but a two-digit high one. And besides, we have to remember that these companies, that a number of these companies were from the grocery or from the food sector. There was a severe winter, a lot of losses suffered. So let's hope that the moods will improve, especially after Euro 2012. And now the second part of our panel. How will the market look in the near future? And here we would like to go beyond Poland, to have a broader perspective. I have a number of questions written down, which I prepared in March. And I have a question like that. It seems that the Eurozone problems are over because Greece did not default and there was no exit from the Eurozone. But it turns out that history is faster than our conference. But I think we have to ask this question. I think it's a question to Paweł. How do you perceive this issue, the macro issue and its impact on our capital markets? And while I'm at it, an additional question. In this perspective, Poland is still perceived as an emerging market. That's how we've been perceived for the past 20 years, which was justified some years ago. Is it still justified? And also, Czech Republic, Hungary, Poland are put in one bag. Shouldn't Poland be perceived from a broader perspective, like put in the one bag as Russia or Turkey? Responding to what you mentioned about the Ukrainian companies, it's not the question of Ukrainian companies only. There are a number of Polish companies that operate on the principle, if things are good, we will be happy to meet you. If things are bad, it's difficult to get in touch with them. And there are companies that have problems with the quality of reporting, especially in the construction industry recently. And as for the second issue, the fact that we are still a developing market, I think it's still good because we still have access to funds which specialize in global emerging markets. Once countries are reclassified to developed markets, they normally lose because they have a small share in the portfolios of the funds. And until we build the economy, the critical mass, we will not gain. So it's good that we are still in the emerging markets group. From the institutional perspective, when we meet different investors, we believe that we are a developed market. Our political stability, our institutions can qualify us to develop markets. But with the incomes at the level of 50% of the EU average, with the productivity figures and so on and so forth, we are still a country that's still chasing Europe. We are still a developing country, which is good because it gives us a potential for further growth. As for the crisis in the Eurozone, I'd like to ask you how much time I've got. 2 minutes and 1 second. Well, the question is simple. From the perspective of a big Polish bank, would it be better or worse if Greece exited Euro today? What's happening in the Eurozone is not good for us. From the global perspective, in investment perspective, we are perceived as a country that's close to Euro. So investors perceive Latin America or Asia as regions that are more attractive or less threatened by the negative consequences of the crisis. That's one issue. And obviously we try to emphasize that only 40% of our GDP is generated by export, that Germany is our main export partner, 60%. Now in Europe we have two groups of countries, the Southern Europe countries, which have a major problem. They have to go through a painful adaptation period. And there is a group of countries that go through a normal economic cycle and are going through economic slowdown, but following a standard economic cycle. But obviously we could write a lot about countries like Greece or Spain. But when we look at the data regarding the scale of the day, the differences in the level of competitiveness of the economies, the picture is very bad. It might lead to the situation that we've had in Japan for the past 20 years, that these countries will be flooded with IV, with new money, like in Japan, but the country will get stuck and will be there for 20 years, like Japan, or there will be a split, and some countries will leave the Eurozone. The total disintegration of Eurozone is rather unrealistic. So we keep modeling such scenarios. What will happen if Greece exits? What will happen if Spain exits? The results are not very optimistic. We are talking about a few percentages of decline of the GDP, and we'll have the huge pressure in the labor market, in the banking market. So there are no easy solutions, but we have to get used to the situation, to the assumption that this will last for the next 3 or 4 years, and we have to get accustomed, get used to this. Well, let's hope that PKO BP will not be so afraid, and it will keep fighting to be the leader in the growth area, because it looks like you've been a bit weaker in relation to your competitors. Well, we try not to be the price leader, that's for sure. Because there is so much of this pessimism around when we look at bond valuations. So with equities, will it always be so bad? Although one of the global strategists wrote recently that it's the time for buying and selling bonds for the next 10 years. And on the downside is not very big here. But that's the question that funds all over the world ask themselves. Isn't it time for changing the trends regarding the ratio of equities and bonds? But what would have to happen in China, in Greece, in Poland, so that the trend diverts? Well, that's by way of recommendation. There is a saying that strategy is the king, but execution is King Kong. I think it got the Nobel Prize. So I would agree that that's the time to buy shares. But today, should we buy them today or in half a year? From the perspective of funds, our investments are unique. From the perspective of long-term savings, it might be good to start by building the basis. But the mark-to-market over the next half a year might be killing, right? I think that's the thing. It's easier to talk about where the picture of the equity market in 10 years than in 1 week or 1 month. And a comment regarding the question whether Poland is an emerging market or an emerged market. What's the most dangerous to us is the repetition of the history that took place in the debt market some time ago. That is when we were between one and the other. The offered rates of return were not the ones expected by investors from emerging markets, but the perception of the risk did not allow to treat Poland as a safe, secure market. What we can see now, when the bonds are much more stable than the equity market or even currencies, even the currency, it seems that the perception of the risk is better, despite all the concerns about the debt level or deficit. I think we are over with the perception that we are a totally emerging market. But where are we in equities? It would be worse if we were in the middle. That would be a big problem indeed. Thank you. A small digression. The perception is changing. How we look at the different classes of asset classes. Sometimes we behave like mature markets that provide much lower returns, and the performance on our assets is comparable to the mature markets. But in the fear periods, the risk, speaking colloquially, is off. And then we are treated as a purely emerging market with a huge risk profile. So I think it's changing. I hope it's changing. although I'm not quite convinced about that when I look at the currency, for example, which is the most liquid asset, and what's happening there. So, ladies and gentlemen, I don't think it's the time to commit a suicide. There is still hope. We are running out of time. We'll be winding up of this panel. Obviously, there will be a Q&A session. But before questions, I'd like to refer to an event that's starting in Poland and Ukraine